Real talk. Microsoft, Google, Amazon, Meta. 4 companies sitting inside your 401k right now. Combined, they're spending $725 billion on AI in 2026 alone. Amazon, $200 billion. Google, $185 billion. Meta, $125 billion. Microsoft, $120 billion. Now here's the question nobody on CNBC is asking. Where is the actual profit? Because buried inside these numbers is an accounting trick so perfectly legal, so completely hidden in plain sight, that by the time most Americans figure it out, it'll already be too late. Let's get into it.
The trick. Here's how this works. When you or I spend money, it's gone immediately. But when Microsoft buys a $500 million AI server farm, accounting rules let them do something very different. Instead of counting that entire cost right now, they spread it across 5 to 6 years, a little bit each year. This is called depreciation. So when Microsoft spends $120 billion on AI hardware this year, only a fraction of that cost shows up on their income statement right now. The rest gets quietly pushed into future years. The profit looks incredible today. The pain comes later.
Here's the actual math. Across all 4 companies, reported depreciation is roughly $149 billion against $434 billion of actual spending. These companies are spending $3 for every $1 of cost that hits their books right now. The other $2 coming later, whether the AI revenue shows up or not.
The cash is disappearing. Now, here's where it gets really uncomfortable. Analysts at Barclays are now modeling negative free cash flow for Meta in 2027 and 2028. Their exact words, which is somewhat shocking to us, but likely what we eventually see for all companies in the AI infrastructure arms race. Negative free cash flow for Meta, one of the most profitable companies in American history. Amazon is looking at a $28 billion cash deficit in 2026, according to Bank of America. Amazon has already filed with the SEC that it may need to raise more debt and equity just to keep building.
And these companies are already borrowing at a historic scale. Meta raised $30 billion in bonds in late 2025, the largest investment-grade deal of the entire year. Google raised $56 billion across 2 bond raises. Amazon added another $40 billion in fresh debt. These are not struggling companies, but they are borrowing at a scale that should make every investor pay very close attention.
The Michael Burry warning. You might know Michael Burry, the investor who bet against housing before the 2008 crash, the guy from The Big Short. His math on this? Meta, Amazon, Microsoft, Alphabet, and Oracle will collectively understate depreciation by approximately $176 billion between 2026 and 2028. $176 billion in real costs that don't fully show up on the income statements investors are using to value these companies right now.
Bank of America specifically warned that AI depreciation costs are only just starting to hit income statements as billions in recent hardware spending converts from construction into operational assets. And here's the part that locked me in. The Big Five spent $448 billion on AI infrastructure in 2025 alone. All of that new hardware is sitting on balance sheets waiting to start depreciating. The gap likely doubles by 2027 just from commitments already made. Every single quarter, more of these deferred costs start hitting income statements, like a wave building offshore that the math guarantees is coming, whether the AI revenue is ready or not.
What this means for your money. Here's why this matters for everyday Americans. If you have a 401k, you own these stocks. If you have an S&P 500 index fund, you own these stocks. If you have any retirement account at all, you own Microsoft, Google, Amazon, and Meta. Right now, those stocks are being valued on earnings that include a significant accounting timing benefit that is mathematically guaranteed to narrow over the next 2 to 3 years. And the entire American stock market is riding on one single bet.
That AI revenue grows fast enough to absorb a depreciation wave that is already locked in and coming regardless. The S&P 500 earnings growth estimate has climbed from roughly 14% in February to north of 23% now. Everything looks incredible on paper. But that wave arrives whether the AI revenue shows up or not. That's not a reason to panic, but it is absolutely a reason to understand what you actually own.
Here's your Darwinomics takeaway. $725 billion in AI hardware is sitting on balance sheets right now, waiting to hit income statements over the next few years. The companies spending it are borrowing billions to keep going. And the earnings Wall Street is celebrating today don't yet reflect the full cost of the bet being made. The math is locked in. The only variable is whether the revenue catches up in time. Subscribe to Darwinomics. Every week, no fluff, no spin, just the truth. Do you think AI revenue will catch up, or is the depreciation wall going to hurt first? Drop it below. I'm Darwin. Stay sharp. Peace.